Hi there. In this video, we explain the 2026 spring statement changes to national insurance caps and what they mean for self-employed people.
If you have a full-time job and run a side business, you might be overpaying thousands of pounds in taxes without realizing it. The payroll system at your day job and the self-assessment system for your freelance work operate independently, which means both are taking their full cut of your income. To prevent you from being charged twice, the 2026 tax year relies on a specific mechanism, the £3,496 annual national insurance cap. It acts as a hard limit on what you actually owe across all your combined income streams. We've teamed up with the experts at My Tax Accountant to walk you through a complete step-by-step audit. We'll show you exactly how to calculate your true liability, claim your state pension credits, and keep HMRC from taking more than its fair share. With national insurance thresholds frozen and Class 2 contributions abolished, relying on last year's math will leave you exposed. Every multi-income earner needs to audit their national insurance strategy before filing. This animated diagram breaks down how the new rules handling your state pension. Mandatory Class 2 contributions are officially gone. If your self-employed profits sit between £7,105 and £12,569, you enter the free credit zone. You pay absolutely nothing, but HMRC treats your contributions as paid, keeping your pension record active. But if your profits dip below £7,104, you lose that automatic credit. To fill the gap, you have the option to make a voluntary payment of $3.65 per week. That adds up to about £189 for the entire year. By paying that small amount, you secure a qualifying year toward your state pension, protecting an entitlement that pays out over $11,500 annually in retirement. Understanding these lower brackets ensures you don't accidentally forfeit a massive state benefit just because you had a quiet year in your business. Now let's move up the pyramid to your actual tax bill, known as Class 4 national insurance. You pay zero tax on your first $12,570 of profit. Anything you earn above that, up to £50,270, is taxed at a primary rate of 6%. Once your profits climb above that £50,000 threshold, the rate drops sharply, taxing any remaining earnings at just 2%. In that scenario, her employer automatically deducts 8% in Class 1 national insurance from her salary, while HMRC's self-assessment system is simultaneously asking for 6% on her freelance profits. This chart illustrates the solution. UK tax law enforces an annual national insurance maximum. For 2026, you are only required to pay a maximum of roughly £3,496 across your combined main rate contributions. Once your payments hit that hard ceiling, your rate on any further earnings drops to 2%. The core issue is that your payroll and self-assessment portal do not communicate in real time. Each system calculates its share as if the other doesn't exist. To link these accounts and prevent an automatic overcharge, you have to manually file for national insurance deferment using Form CA72A. Standard online tax calculators usually treat employment and self-employment as isolated bubbles. If you earn from multiple streams, relying on basic tools can easily lead to a massive, unnecessary overpayment. Managing your liability also means managing how you report it. Starting in April 2026, making tax digital for income tax takes effect. It applies to anyone with a gross income, meaning total revenue before expenses, including property income, of more than £50,000. This flowchart shows the mandatory reporting cycle. The old annual tax return is replaced by a 4-step process. First, you maintain continuous digital records using approved software. Second, you submit quarterly updates to HMRC. Third, you file an end-of-period statement for each business. Finally, you submit a cumulative final declaration to calculate your total tax. The rules are also tightening for UK citizens working abroad. The voluntary Class 2 rates for expats are being removed. If you live overseas and want to keep your UK pension active, you will be required to pay the higher Class 3 voluntary rate for any periods after April 2026. Under this 2026 mandate, managing your taxes becomes a continuous process of digital quarterly submissions and software-based record-keeping. Let's review our checklist. You now know how to secure your state pension with lower-tier credits, how to calculate your exact Class 4 liability, and how to use deferment to apply the multi-income cap. Keep in mind that UK tax laws are highly complex and constantly evolving. The information in this video is for general guidance and is not a substitute for tailored professional advice specific to your situation. If you need help navigating making tax digital, claiming your deferment, or calculating your exact caps, get in touch with my tax accountant. Their experts can build a personalized strategy to protect your earnings. With steeper penalties and stricter reporting rules, proactive planning is simply your best defense against overpaying the government. If you found this breakdown helpful, please like this video, subscribe to the channel, and we'll see you in the next one.